If you observe historical patterns closely, you'll notice that 2026 won't be an ordinary year for investors. We're in a unique moment in modern economic history, a time when traditional investment rules are being rewritten by the forces of cycles that few truly understand. This is not a prediction, but a logical outcome of forces already in motion. After studying markets, crises, and recoveries for over 4 decades, I have learned that history is a great teacher. And right now, it's showing us clear signs that certain asset classes will become dangerous traps for wealth in the coming years. Many investors are repeating the same mistakes I saw destroy fortunes in 1987, 2000, and 2008. They are investing based on what worked yesterday, not on what will work tomorrow. The difference now is that the consequences may be even more severe. We are dealing with unprecedented debt levels, deep structural shifts in the global economy, and a power transition that only happens once per century. If you understand the incentives, you understand the behavior. And right now, those incentives are creating bubbles in places you might not expect. Today, I'll show you exactly where these bubbles are forming and why avoiding them could be the most important decision of your financial life. History teaches us that all great wealth transfers follow predictable patterns. In 1929, investors believed that this time it was different. Stocks surged to astronomical levels based purely on speculation, not on economic fundamental. The result was a decade of depression. In 1999, the same phrase was heard on Wall Street. The internet is changing everything. Old rules don't apply. We are in a new economy. We all know how that ended in 2007. Real estate never falls. It's a safe investment. Everyone needs a place to live. Once again, collective arrogance led to destroyed fortunes. The pattern remains the same: euphoria, denial of reality, overconfidence, and overvalued assets, followed by a painful wake-up call. We are witnessing the same signs today, but on a much larger scale. The key difference is that now we're not just dealing with localized bubbles, we are facing simultaneous bubbles in multiple asset classes, all fueled by a decade of experimental monetary policies. Since 2008, central banks have pumped over $20 trillion into the global economy. This money didn't vanish. It inflated asset prices to levels that defy any economic logic. If you look closely at the data, you'll see we are living through the largest monetary experiment in history. And as with all experiments, eventually we get to the results. To understand why certain asset classes will become toxic in 2026, we must first grasp the fundamental principles of investments. Every investment is essentially a trade-off between risk and return. When prices rise too much, future returns decrease and risk increases proportionally. It's a physical law of financial markets. There's no free lunch. Today, we see assets that offer low returns but come with extraordinarily high risks. This is the opposite of what smart investors seek. The economy operates in cycles: expansion, peak, contraction, trough, and expansion again. These cycles are as inevitable as the changing seasons. They're short-term cycles lasting about 7 years and long-term cycles that extend 50 to 100 years. Right now, we are at the end of a long-term cycle, meaning many of the trends we've seen over the past 40 years are about to reverse. When things go well, leverage multiplies gains. When things go poorly, it multiplies losses. Today, we have record levels of leverage across virtually every sector. Companies, governments, and individuals are more indebted than ever before. This means when the cycle turns, and it always does, losses will be amplified. True diversification isn't owning 50 different stocks. It's owning assets that respond differently to the same economic forces. Most investors think they're diversified, but in reality, their assets are all positively correlated with the same variables: economic growth, low inflation, and expansive monetary policies. When these variables change, and all these assets will fall together. Based on these principles and the analysis of current cycles, 3 asset classes stand out as deadly traps for investors in 2026. The first trap is technology stocks that don't generate real profits but are valued based on future potential. If you examine the technology companies that boomed over the past 5 years, you'll notice something troubling. Many of them burn money rather than generate it. They survive because money is cheap, and investors are willing to gamble on future stories instead of current results. Imagine a restaurant that loses money on every meal, but convinces investors it will one day become the world's largest gastronomic empire. While money is cheap, this fantasy can continue, but once money becomes expensive, reality will strike. This is exactly what's happening with hundreds of technology companies today. The fundamental problem is that these companies were built for a world of low interest rates and abundant capital. By 2026, that world will no longer exist. As interest rates rise and capital becomes scarce, these companies will realize they don't have sustainable business models. They were optimized for growth, not profitability. History shows that companies unable to generate money eventually cease to exist, no matter how revolutionary their technology. Since 2010, investors have been pushed to take more risks because of central banks' low interest rate policies. This has led to massive price distortions. Companies that should be worth nothing have been valued in the billions. When this distortion corrects itself, investors exposed to these companies will see their fortunes vanish almost overnight. The second trap is real estate in markets that have experienced unsustainable growth in recent years. If you look at real estate prices in cities like San Francisco, Seattle, Miami, or Austin, you'll see increases that make no economic sense. In many of these cities, prices tripled in just a decade. This happened not because real demand increased, but because cheap money allowed people to pay any price. Imagine an auction where all participants get money for free to bid. Prices rise to absurd levels because no one is using their own money. This is exactly what happened in the U.S. real estate market. Low interest rates made financing cheap, allowing people who couldn't afford homes to qualify for huge loans. Institutional investors entered the market, competing directly with families. Private equity firms bought hundreds of thousands of homes and turned them into rental properties. This artificial demand inflated prices far beyond what the real economy could sustain. Interest rates have already begun rising and will keep rising. This makes financing more expensive and reduces the number of qualified buyers. Additionally, many homeowners who bought recently did so with variable rate mortgages. As these rates adjust, millions of homeowners will find they can no longer afford their mortgages. Moreover, an entire generation of investors has never witnessed a real estate market correction. They believe real estate always goes up, which will make them easy targets when the corrections start. History is clear. When an asset is considered always safe, that's exactly when it becomes most dangerous. The third trap, perhaps the most counterintuitive, is long-term bonds, especially government bonds. For decades, bonds were seen as the safe part of any portfolio, but in an environment of rising inflation, long-term bonds become one of the worst asset classes. Imagine lending money at 3% interest for 30 years. If inflation averages 5% per year, you're essentially paying to lend your money. This is what's happening with government bonds today. After a decade of extremely loose monetary policies, inflation is here to stay. Governments worldwide have accumulated debts that are impossible to pay with honest money. The only way to reduce these debts is through inflation, meaning the purchasing power of currencies will continue to decline, making fixed rate bonds a losing investment. Many investors still think as if we're in the 1,980 seconds or 1,990 seconds when inflation was under control and bonds offered positive real returns. Others are forced by regulations to hold bonds regardless of their appeal. Pension funds, insurance companies, and banks have mandates that require them to buy bonds even when it's clear they're a bad investment. This artificially creates demand, but it doesn't change the underlying reality. By 2026, when inflation becomes persistent and central banks are forced to raise rates dramatically, bondholders will face catastrophic losses. For Americans between the ages of 40 and 80, these trends will directly impact your financial security and retirement plan. Many retirement strategies assume 7 to 8% annual stock returns and 3 to 4% returns from bonds. These figures were realistic over the last 40 years, but won't be in the next decade. If your plan depends on these returns and you're exposed to the asset classes I've mentioned, you'll either need to work longer or accept a lower standard of living in retirement. For those already retired, the situation is even more critical. You don't have time to recover from significant losses. If a large portion of your wealth is in overvalued real estate or long-term bonds, you might see decades of savings evaporate in just a few years. Many Americans invest through index funds, believing they're safe because of diversification. But the major indices are heavily weighted toward the types of assets that will face problems: overvalued technology stocks and highly leveraged companies. When these sectors correct, index funds will fall along with them, dragging millions of unsuspecting investors down. Consider a couple in their mid-50 seconds with $800,000 in retirement savings. If 60% is in stocks, mostly technology through funds, 30% in bonds, and they own a house bought for $600,000 in 2021, their net worth could plummet dramatically in a market correction. This isn't wild speculation. It's based on historical data from similar market crashes. There are ways to protect and even grow your wealth in the approaching turbulent period. True diversification means owning assets that perform well in different economic conditions. In an inflationary environment, you need assets that hold or increase value when currency loses purchasing power. Essential commodities like energy, precious metals, and agricultural products have historically performed well in inflationary periods. These are basic necessities that will always be in demand. Companies that own natural resources or can pass on costs to consumers, like energy companies, well-regulated utilities, and essential consumer goods companies, will do well. Real estate in areas offering real value, not speculative properties, will be a good investment in markets with strong fundamentals. Not all markets are equal. While some regions will face severe corrections, others will present opportunities. Look for markets where prices still reflect real economic value, not speculation. In high-risk environments, staying out of the market is often the smartest choice. Don't feel pressured to be fully invested all the time. Wait for clear opportunities where the risk is low and potential returns are high. If you have debts, consider converting them to fixed rates while it's still possible. When inflation accelerates, central banks will raise rates, which will make borrowing costs rise. A portion of your wealth should be in things with intrinsic value, independent of currency. This includes precious metals, essential commodities, and stakes in companies that own real resources. The financial world is changing rapidly. Strategies that worked for decades may no longer be effective. Don't limit your knowledge to stocks and bonds. Learn about commodities, currencies, different types of real estate, and inflation protection instruments. Understanding the patterns of past economic cycles will better prepare you for the next one. Great wealth transfers always occur during times of transition. These are not moments of panic or despair, but moments of clarity for those who see beyond the market noise. Most investors lose money during transitions because they resist the forces of the cycles rather than working with them. Temporary wealth is built by betting that current trends will continue forever. It's easy to make money during bubbles until they burst. Lasting wealth is built by understanding that all trends eventually reverse and positioning yourself to profit from both the highs and lows. The most successful investors in history were those who understood fundamental principles and positioned themselves according to them. The market is more complex than any individual. Accepting this is the first step in protecting your wealth. When you understand that, you can't predict exactly when or how corrections will happen, but can prepare for them when they do, you become a smarter investor. Arrogance destroys more wealth than any economic crisis. Humility preserves it through any cycle. When I say to avoid certain investments, I'm not predicting specific timing. I'm pointing out a mathematical reality. Some asset classes are priced as if scenarios that can't be sustained are actually possible. You can choose to believe that this time is different. You can bet that the basic laws of risk and return have been suspended. But if you study history and understand these principles, you'll know that the bet will eventually be a losing one. Every correction creates extraordinary opportunities for prepared investors. The best companies in the world will be available at prices we haven't seen in decades. Real estate in prime locations will return to offering attractive real returns. Bonds will once again be sensible investments when rates reflect the inflation reality. But these opportunities will only be available to those who have preserved capital during the turbulent period. If you avoid the traps I've identified, you'll be well positioned to take advantage of the opportunities that will come. Great economic cycles are like the seasons. You can't prevent winter from coming, but you can prepare for it. We're heading into an economic winter after a long period of prosperity. Those who prepare properly won't just survive, but will thrive when spring returns. History teaches us that after every great correction, a new cycle of prosperity based on solid fundamentals will emerge. Those who understand this and act accordingly will be the wealth creators of the next era. The choice is yours. You can fight against the inevitable cycles, or you can work with them. One leads to frustration and loss, the other leads to lasting prosperity. If you observe carefully, the difference is clear. Cycles are like gravity. You can ignore them, but you can't escape them. Wisdom lies in understanding them and using their power to your advantage. Since 2008, central banks have pumped over $20 trillion into the global economy. This influx of money didn't just disappear. It inflated asset prices to absurd levels. If you analyze the data closely, you'll realize that we are currently experiencing the largest monetary experiment in human history. And like all experiments, there will be results. The problem with this type of monetary policy is that it distorts the natural balance between supply and demand. When money is cheap and easily available, it tends to inflate the prices of assets, regardless of their actual value. This has created an environment where the risk is being hidden behind rising asset prices. The result of this distortion is that we are facing an environment filled with financial bubbles. These bubbles are not isolated, but are widespread, affecting a variety of asset classes. Technology, stocks, real estate, and long-term bonds are all showing signs of inflated valuations. And the most dangerous part is that many investors are still stuck in the mindset that the past will continue without considering the massive changes happening in the economy. When you look at the technology sector, you see a pattern emerging. Technology stocks are being valued based on future potential rather than actual profits. Many of these companies are burning money instead of generating it. They have managed to survive because of the availability of cheap money. Investors are betting on the future rather than focusing on the present. Imagine a restaurant that loses money with every meal but convinces investors that it will become the largest restaurant chain in the world. As long as money is cheap, this fantasy can continue, but when capital becomes more expensive, the reality sets in, and many of these companies will not be able to survive. The harsh truth is that companies built for a world of low interest rates and abundant capital will struggle when the economy shifts. The second bubble to watch out for is the real estate market. If you look at the price increases in cities like San Francisco, Seattle, Miami, or Austin, you'll see prices rising to levels that don't make sense. Prices tripled in some markets over the last decade, not because of real demand, but because of easy access to cheap credit. The affordability of mortgages and the competition between institutional investors and regular buyers have artificially inflated real estate prices. But this is about to change. With rising interest rates, financing will become more expensive, which will reduce the pool of qualified buyers. Many homeowners who bought in recent years did so with adjustable rate mortgages. As these rates increase, millions of homeowners will find themselves unable to afford their monthly payment. A significant portion of homeowners have never experienced the real estate market correction and believe that property prices always go up. This blind confidence will make them easy victims when the correction happens. History has shown that when something is considered safe for too long, that's when it becomes the most dangerous. The third bubble, and perhaps the most counterintuitive one, is long-term bonds. For decades, bonds were seen as the safe investment, the anchor of any balanced portfolio. But in today's inflationary environment, long-term bonds have become a losing bet. Imagine lending money for 30 years at a fixed 3% interest rate, while inflation is at 5% per year. You're essentially paying to lend your money. This is exactly what's happening today with long-term government bonds. After a decade of extremely loose monetary policies, inflation is making a return, and it's here to stay. Governments around the world have accumulated unsustainable debt, and the only way to reduce it is through inflation. This will erode the purchasing power of money, and fixed-rate bonds will become increasingly unattractive as an investment. Yet many investors still behave as if we're in the 1,980 seconds or 1,990 seconds when inflation was under control and bonds offered positive return. Pension funds and insurance companies are still required by regulation to hold bonds, regardless of how poor an investment they may be. This forced demand is keeping bond prices high, but it doesn't change the underlying reality. In 2026, as inflation persists and central banks are forced to raise interest rates, bondholders will face devastating losses. For those in their 40 seconds to 80 seconds, these trends will directly affect your financial security and retirement plan. Many retirement strategies are built on assumptions of 7 to 8% annual returns on stocks and 3 to 4% on bonds. These returns were realistic over the past 40 years, but they won't be in the next decade. If your plan relies on these returns, and you are exposed to the asset classes I've mentioned, you'll need to work longer or accept a lower standard of living in retirement. For those who are already retired, the situation is even more critical. You don't have time to recover from significant losses. If a large portion of your wealth is tied up in overvalued real estate or long-term bonds, you could see decades of savings disappear in just a few years. If you bought a home in an overheated market in the past 5 years, You may find that you owe more than your home is worth, limiting your financial mobility and possibly forcing you to continue paying for something that has become a liability instead of an asset. Many Americans invest through index funds, believing that they are safe because of diversification. But the truth is, the major indices are heavily weighted toward the very assets that will face major problems. These indices have large concentrations in overvalued technology stocks and highly leveraged companies. When these sectors correct, index funds will fall along with them, taking millions of unsuspecting investors down with them. For example, consider a couple in their mid-50 seconds with $800,000 in retirement savings. If 60% of that is invested in stocks, mainly through technology-focused funds, 30% is in bonds, and they own a house bought for $600,000 in 2021, their net worth could fall dramatically in the event of a market correction. In a correction scenario, stocks could drop by 50%, bonds by 30%, and the house by 40%. Their net worth would go from about $1.4 million to less than $700,000. This isn't an unlikely scenario. It's based on historical data from previous corrections and the principles that govern economic cycles. So, what can you do to protect and even grow your wealth in the coming turbulent period? The first step is understanding that true diversification is not about owning 50 different stocks. True diversification means owning assets that respond differently to the same economic forces. In an inflationary environment, you need assets that will either hold or increase their value when currency loses purchasing power. Essential commodities like energy, precious metals, and agricultural products have historically performed well during inflationary periods. These are basic necessities that will always be in demand. And companies that own natural resources, or those that can pass on price increases to consumers, such as energy companies, utilities, and essential consumer goods businesses, will thrive. Real estate in certain locations that offer true value, not speculative properties, will also be a good investment, but not all markets are equal. Some regions will experience sharp corrections, while others will present opportunities. Look for areas where prices still reflect real economic value, not speculative price hikes. Generally, these are smaller markets that didn't see the same speculative boom as larger cities and regions with genuine economic diversification, not those dependent on a single industry or employer. Energy, transportation, basic telecommunications, and companies that solve real-world problems with proven business models are also good places to park your money. These are companies that have consistently generated revenue for years and have business models that stand the test of time. The exact timing of when these corrections will begin is less important than positioning yourself correctly when they do arrive. Keep a significant portion of your wealth in cash or cash equivalents. Yes, inflation will erode its value over time, but losing 5% per year to inflation is better than losing 50% in a market correction. When the correction hits, you'll have the capital to buy high-quality assets at discounted prices. Don't feel pressured to be fully invested all the time. In high-risk environments, staying out of the market is often the best decision. Wait for clear opportunities where the risk is low and the potential for return is high. Accept that we are entering a period of persistent inflation and position yourself accordingly. If you have debts, try to convert them to fixed rate loans while you still can. When inflation accelerates, central banks will be forced to raise interest rates sharply, and debt tied to variable rates will become much more expensive.